Welcome to the Deep Dive. We're here to cut through the noise and give you the insights you really need to stay informed. Today, we're getting into a pretty high-stakes story. It's Plug Power Inc., trading on NASDAQ as PLX. This is a company really at a crossroads. You've got this big vision, a clean energy future, but it's clashing head-on with a really tough financial history. So the big question, the one we want you to think about is, can Plug Power actually pioneer this hydrogen economy? Or is it just going to keep burning through cash? By the end of this, you should have a much clearer picture of what needs to happen for either outcome.
That's exactly right. Our analysis today is centered around August 16, 2025. Plug Power stock closed at $1.70 the day before August 15th. And our mission really is to dig into that core investment thesis, understand Plug Power's, well, let's say, complex journey. And we want to equip you with the most important pieces of information without, getting lost in the weeds.
Yeah, exactly. So to keep things clear, we've broken this down into two main parts. Part one, we'll lay the groundwork. We'll look at the business itself, take a hard look at the management team, and then really dive deep into the financials.
And then in part two, we'll zoom out a bit, look at market sentiment, check out their ownership structure, which is quite interesting. We'll do a full risk assessment, and then finally pull it all together to give you the complete picture.
Okay, before we jump right in, just a quick reminder, like and subscribe to Stock Analytics AI over on YouTube. Our members, it's $4.99 a month, get priority deep dives on the tickers they want to see. We're actually planning to cover all the S&P 500 stocks in the next few months, and members get first dibs on those analyses. And hey, if you just want a one-off deep dive on a company you're interested in, just drop us a super thanks. All right, let's get started then. Chapter 1, the business of green hydrogen. So maybe start with the basics. What is Plug Power's core mission right now? And, how did it get here?
Well, Plug Power's really gone through a big strategic shift. Their main goal now is to build what they call an end-to-end, vertically integrated green hydrogen ecosystem. See, historically, their big problem was selling the fuel cells, but then having to buy hydrogen from other companies, and they were reselling it at a loss. That was killing their margins. So this new strategy, which is incredibly capital intensive, mind you, is all about gaining control over hydrogen production and its costs. The idea is to finally make the whole thing sustainable. But the execution risk here is just immense, given the scale of what they're trying to build.
Okay, right. Control their own destiny, basically.
Mm-hmm.
So what specific solutions or products are they actually offering in this ecosystem?
They've got a whole suite, really. First is GenDrive. That's their well-known fuel cell system for material handling. Think forklifts, replacing old lead-acid batteries, very established there. Then there's GenSure. That's for stationary backup power, critical for things like telecom towers, data centers. For making the hydrogen itself, they have the Geneco platform. This uses their own proprietary PE electrolyzer tech to make green hydrogen from water carbon-free. And finally, GenFuel. This covers the whole infrastructure side, hydrogen liquefaction, storage, cryogenic tanks, and the actual dispensing systems. They really are aiming for the whole chain.
Wow, yeah. It sounds like building the highway and the gas stations.
Yeah.
So given that ambition, where do they actually stand in the market? You mentioned they have a head start.
They definitely do. They're seen as a first mover, especially in that material handling space. They've put more fuel cell systems out there than anyone else globally, and they're actually the single biggest buyer of liquid hydrogen currently. Plus, their customer list. It's got giants like Amazon, Walmart, Home Depot. That gives them serious validation. But it also creates significant customer concentration risks. They're quite reliant on those big players.
Right. So beyond just the green aspect, what are the concrete benefits for those big customers? What's the real value proposition?
It really boils down to two main things. Decarbonization, yes, that's huge, but also operational efficiency, especially for high throughput places like warehouses. Hydrogen forklifts refuel in minutes, literally minutes, compared to hours for batteries. They give consistent power, no fading during a shift, and they free up valuable warehouse space because you don't need those big battery charging rooms anymore. It's a real operational plus.
Okay, let's zoom out a bit then. What does all this mean for the kind of the bigger picture, the hydrogen economy, the industry they're in? What are the key trends?
Well, the global fuel cell market itself is definitely expected to grow, vigorously, in fact. It's driven by that global push for decarbonization, government incentives kicking in, and just rising demand across different sectors. Forecasts are talking like maybe $9 billion in 2024, growing to over $40 billion by the early 2030s. That's a pretty hefty growth rate, Competition-wise, you've got direct players like Ballard Power Systems, Fuel Cell Energy. They're in the same space. But honestly, the bigger long-term threat might come from the huge industrial companies. Think Cummins. They have massive manufacturing scale, global distribution. They're moving into hydrogen and electrolyzers too. That's serious competition. And this is critical. The hydrogen industry, especially green hydrogen, is incredibly dependent on government policy, like exceptionally dependent. In the US, the Inflation Reduction Act, the IRA, and the bipartisan infrastructure law are huge tailwinds. Massive. They brought in things like the Section 45V tax credit that's up to $3 per kilogram for clean hydrogen. Plug Power's billions in investment, they're banking on those credits, which means any political change, any regulatory shift, it's an existential threat. It could completely pull the rug out from under their whole strategy. And the barriers to entry, also incredibly high. You need billions, literally billions, for factories like their Gigafactory in Rochester for building hydrogen plants. Plus, the tech itself is complex. PM fuel cells, electrolyzers, requires deep R&D, lots of expertise. It's not an easy market to just jump into.
Okay, so wrapping up this section, with all that context, how would you sum up Plug Power's competitive advantages?
Yeah.
What makes them stand out despite the challenges?
Okay, a few key things. First, brand strength. They are a pioneer, recognized name, especially dominant in material handling. That counts for something. Second, cost advantages. Now, here's the catch. They don't have one yet. Not at all. Gross margins are deeply negative. The whole investment thesis hinges on them achieving economies of scale down the road, using the Gigafactory, using their own hydrogen plants to finally get costs down and make green hydrogen profitably. That's the bet. Third, network effects and switching costs. For those big customers like Amazon, once they've built the infrastructure, integrated the workflow, switching away becomes really difficult and costly. That makes them sticky. And lastly, unique assets. The Gigafactory, their growing network of hydrogen plants, these are real physical assets, hard to replicate quickly. They're the backbone of that vertical integration play.
That leads us nicely into Chapter 2, Management Evaluation. Let's talk about the CEO, Andy Marsh. He's been there a long time, hasn't he? What's the story there?
A very long time. Over 17 years as CEO, which is, quite unusual for a tech-focused company. He had some entrepreneurial success before Plug, but his tenure here, well, frankly, it's been marked by huge costs to shareholders, persistent losses, massive equity dilution, and there was that financial restatement back in March 2021. Accounting errors, it highlighted material weaknesses in their internal controls, led to stock drops, lawsuits. Not a great look for oversight.
Right, that restatement sounds serious. Given that, how have they been on transparency with investors since then?
Well, they are proactive in some ways. They hold investor days, put out detailed presentations, that they communicate. But there's also a history of setting pretty ambitious financial targets and then missing them, which, tends to erode credibility over time for some investors. On a positive note, though, CEO March did agree to take 50% of his 2025 salary in company stock. That does align him more directly with shareholders, which is generally seen as a good sign.
Okay, so how are they actually using all the capital they raised? You mentioned dilution. Where's the money going?
The focus is crystal clear. Growth and vertical integration, almost to the exclusion of everything else, like near-term profits or, avoiding dilution. Billions have gone into organic growth, building that Gigafactory, the hydrogen plants. And they've also made targeted acquisitions to get key tech, like PEM technology or production capacity. And it's really important to stress, they have never paid a dividend, never done share buybacks. All the capital flows outwards into building the business. And the share dilution, it's pretty staggering, honestly. Shares outstanding went from around 458 million in 2020 to about 1.15 billion by mid-2025. Just massive. And they're still using an at-the-market or ATM stock offering program, which basically means further dilution is always a risk hanging over the stock. And when you look at a key metric like return on invested capital, ROIC, how well they use money to make money, it's been consistently deeply negative, like negative 17.7% for the last 12 months. The trend actually shows it getting worse as they deployed more capital recently. It really signifies significant capital destruction, historically speaking. So yeah, it's a high-stakes gamble on the hydrogen economy taking off and them executing perfectly. It's very much a venture capital style play, totally different from traditional value investing.
Which brings us right to Chapter 3, a forensic. Look at the financials. Okay, let's really unpack the numbers. What do they tell us about the company's actual health?
All right, let's get into it. As of mid-August 2025, market cap is hovering around $1.96 billion. Revenue growth, this is key for the bulls, but it's been volatile. They actually saw a decline in 2024 after strong growth. Before that, management's guiding for about $700 million for the full year 2025. Remember, they even had negative revenue back in 2020 due to warrant accounting complexities. So a bumpy road. Profit margins. This is really Plug Power's biggest, most persistent challenge. gross, operating net, all deeply negative for years. Now, there was improvement in Q2 2025. Gross margin got to negative 31%. That's way better than negative 92% the year before, but it still means they spend a $0.31 for every dollar of revenue they bring in, just on the cost of goods sold. Trailing 12 months figures are stark. Gross margin negative 66.5%, operating margin negative 140%, net margin negative 293%. They lose a lot of money in operations. And free cash flow, consistently negative. The cash burn has actually been accelerating as they spend heavily on building things out. Over the last 12 months, negative $819 million burned. You can see the trend. Hundreds of millions burned each year and over $1 billion in both 2023 and 2024. So, financial stability. Look, they have a long, unbroken history of net losses, and those losses actually widened significantly recently, hitting $2.1 billion in 2024, funding that big build-out. The debt-to-equity ratio is 0.56. That might not look terrible at first glance, but you have to remember, the equity part comes mostly from issuing new stock, not from profits. Operations actually reduce equity value here. Their current ratio is 1.59. Okay, that suggests they can cover near-term liabilities. But the quick ratio, if you strip out inventory, which might not be easily convertible to cash, is only 0.45. That points to a heavy reliance on inventory and maybe some underlying weakness in immediate liquidity. And, of course, no dividends.
Wow. Okay, that paints a challenging picture. So how on earth do you even value a company like this? With that history, but those big future plans.
Yeah, it's tough. Standard PE ratio, meaningless with negative earnings. So you look at price to sales, PS, it's more common for high-growth pre-profit companies. Plug's trailing 12-month PS is about 3.04. For comparison, Ballard Power is higher at 7.72. Fuel Cell Energy is lower at 0.76. So the market values Plug sales somewhere in the middle of those peers. Now, intrinsic value, like using a discounted cash flow or DCF model, it is exceptionally difficult for Plug Power. Honestly, it spits out a huge range of possible values. Some educational models, if you extrapolate the recent negative cash flows, actually give you a negative intrinsic value per share, like maybe negative $2.13. Others, if you assume they do succeed, hit those growth targets, turn profitable, they can generate positive values, maybe up to $4.06 per share. This massive conflicting range just highlights how speculative any valuation is right now. It totally depends on your assumptions. And those key assumptions are future growth rate bulls need maybe 25-27% annual growth for years. The discount rate has to be high given the volatility, the cash burn, the uncertainty. And the terminal value, that far future value, is where most of the DCF value comes from. And it's pure speculation at this point.
Okay, let's shift gears now into part 2, starting with chapter 4, market sentiment. Given everything we just heard, how is the market reacting? What's the general feeling out there?
Well, it's fair to say Wall Street is deeply divided on Plug Power. It really reflects that high-risk, high-reward profile we've been talking about. The consensus rating from analysts tends to be hold or maybe even reduce. But if you look at individual price targets, they're all over the map, from as low as $0.50 to as high as $4.50. The average target sits somewhere around $1.80 to $1.92. So suggesting maybe some modest upside from the current $1.70, but yeah, huge uncertainty baked in. Recent news like the Q2 2025 earnings was very mixed. Revenue beat expectations, margins improved, but the cash burn continued, and they lowered their full year guidance to that $700 million figure. So the media tone is often one of like cautious intrigue. You hear high risk, high reward a lot. Looking at market indicators, short interest is exceptionally high. Around 29.3% of the float is sold short. That's a very strong bearish signal from sophisticated investors getting against the stock. The days to cover is between 3.7 and 6 days, meaning it would take several days of average trading volume for all those shorts to buy back their shares. It's a significant, sticky short position, however. Despite that heavy short interest, the recent price action has actually been, well, positive. The $1.70 price is above both its 50-day moving average, around $1.44, and its 200-day, around $1.64. That suggests maybe a technical reversal is underway after a long downtrend. So you've got this real tension, fundamentally bearish signals clashing with positive technical momentum. It creates a really volatile situation. It could easily see a short squeeze on good news, like maybe that DOE loan coming through, or a sharp drop on any negative surprises. High tension right now.
Very interesting dynamic. Okay, let's move to chapter 5. Ownership structure. Who actually owns Plug Power? What does that tell us?
Okay, ownership. Institutions own about 39%, but the biggest holders are passive index funds. Think Vanguard, BlackRock. Their ownership is mostly because Plug is in the indices they track, not necessarily because they have deep conviction in the company's turnaround. And their recent buying-selling has been mixed. Insider holdings, very low, less than 1% collectively, which isn't always a great sign. But there has been some notably positive insider buying recently. Specifically, the CFO, Paul Middleton, bought 1 million shares back in May-June 2025, spent nearly $1 million. That is a significant signal of confidence from someone who knows the inner workings. But the really striking thing about Plug's ownership is who holds the most shares. It's the retail investors. The general public controls around 56% of the company. The top 25 shareholders, including those big index funds, own less than 40%. So what does this mean? Well, this structure dominated by passive funds and a huge retail base with low active institutional and insider ownership makes the stock incredibly sensitive to narratives, to sentiment. It's prone to those dramatic boom and bust cycles you sometimes see. The CFO's buying is a notable countersignal, yes, but it's still a small piece compared to the massive retail float.
Got it. Okay, let's try to pull all these threads together now in Chapter 6, Risk Assessment. How does a quick SWOT analysis look for Plug Power? Strengths, weaknesses, opportunities, threats.
Sure. Strengths. Market leadership, particularly in material handling. That integrated tech stack they're building, the blue-chip customer base providing validation, and the expanding production footprint, the gigafactory, the hydrogen plants. Weaknesses. Obvious ones. Severe cash burn, negative free cash flow, heavy reliance on capital markets leading to dilution risk, and just immense execution risk in scaling up all these complex projects simultaneously. Opportunities. Huge addressable market in the energy transition. That favorable regulatory environment, especially the IRA, is a massive opportunity if it holds. Expansion into new markets, stationary power, maybe on-road vehicles, eventually Europe, and the potential, down the line, to actually become a cost leader in green hydrogen. Threats. Intense competition, both from specialists and those big industrial players. Policy risk if those subsidies change or disappear, it's a huge threat. Technological disruption, maybe next-gen batteries, leapfrog fuel cells in some applications. And capital markets risk what if they can't raise money on decent terms in the future? That could trigger a liquidity crisis. And we should touch on macro factors, too. Plug Power is acutely sensitive to interest rates. Being so capital intensive, higher rates mean higher borrowing costs, makes equity financing tougher. Plus, it's what you'd call a long-duration asset. Its value is based on profits way out in the future. Higher interest rates hammer the present value of those distant cash flows, puts direct downward pressure on the stock valuation. And specific geopolitical factors matter too, like those Liberation Day tariffs from the Trump administration in 2025. Directly, things like a 25% tariff on steel or aluminum could raise their construction costs. Retaliatory tariffs from, say, Europe could hurt international plans. But maybe the biggest threat there is just the political uncertainty. If the administration is skeptical about clean energy, it casts doubt on the long-term stability of those crucial IRA credits. And those credits are fundamental to their whole green hydrogen strategy.
We've definitely covered a lot. So, for our final section, Chapter 7, conclusion, let's synthesize. What does this all mean for you, the listener, if you're considering this stock?
Okay, let's frame the two sides. The bull case is really a bet on the future. It's a belief that Plug Power will become a leader in this massive, growing hydrogen industry. Bulls point to what they see as a developing competitive moat. The validation from big customers, those powerful government tailwinds like the IRA, and those recent improvements in operational metrics like gross margin as signs they're on the path to profitability. For bulls, the current low stock price is a deep value opportunity to get in early on a key player in the multi-trillion-dollar energy transition. Then you have the bear case. This is rooted much more in the company's financial reality and its history. Bears point to 2 decades of, frankly, shareholder value destruction, the relentless cash burn, the staggering dilution, the consistent failure to actually make a profit. They stress the huge execution risk, the complexity of what they're trying to do, and that fundamental dependence on government subsidies, on political whims, as some might say. For bears, the risk of a liquidity crisis down the road, or just more and more dilution, simply outweighs any speculative future potential. So to sum up the valuation piece again, intrinsic value is extremely uncertain, highly speculative. Remember that wide DCF range from the educational models, potentially negative, like negative $2.13, or potentially positive and maybe $4.06. That massive gap just tells you valuation here is almost entirely dependent on whether you believe in a highly uncertain long-term story. So as we record this, August 16, 2025, the share price is $1.70. That price clearly reflects deep market skepticism. It's pricing in a lot of the risks we talked about in the bear case. Plug Power is without doubt a polarizing investment. It pits this really compelling vision of a clean energy future against a very harsh financial track record. Investing in PLG today is an explicit bet. A bet on management executing almost perfectly, a bet on the regulatory environment staying favorable and stable, and a bet on the company successfully making that incredibly difficult transition from burning cash to generating sustainable profits. The potential reward, if they pull it off, could be significant, but the risks,
The risks of substantial or even total loss of capital are equally pronounced.
A really fascinating high-stakes situation indeed. As you mull over everything we've discussed about Plug Power, here's a final thought to consider. What does it truly take for any company to bridge that huge gap between an ambitious vision and actual sustainable profitability, especially in a brand new, super capital-intensive industry like green hydrogen? Or, maybe put it this way, how much future potential should you, as an investor, weigh against a long history of losses and shareholder dilution? Definitely something to think about. And one last time, please do like this deep dive and subscribe to Stock Analytics AI on YouTube. Remember, members get priority requests for deep dives at €4.99 a month. We're covering all the S&P 500 soon. Members get priority access. And for one-off requests, super thanks is always an option.
And finally, the important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice. Please, always do your own research or consult with a qualified financial advisor before making any investment decisions.